A lot of founders think the hard part is opening the company. It usually isn't. The hard part is what comes after, understanding which taxes are real taxes, which filings are just reporting, which deadlines belong to Delaware, which belong to the IRS, and which mistakes trigger penalties even when the business made little or no money. Delaware corporations owe an annual franchise tax and an annual report by March 1st, while Delaware LLCs owe a separate annual tax by June 1st. None of that is the same thing as federal income tax. So, in this video, Icon.Partners will provide you with a practical founder guide to US taxes and reporting in 2026. The difference between Delaware franchise tax and federal income tax, how tax treaties actually help, what BOI reporting looks like after the 2025 rule change, and which IRS deadlines are most likely to produce painful penalties. The point is simple. In the US, penalties often come from confusion, not from fraud.
When founders say, "What taxes do we owe in the US?" they usually mix three different systems into one question. Lane 1 is Delaware entity maintenance, franchise tax, and for corporations, the annual report. Lane 2 is federal tax, income tax returns, information returns, estimated tax, payroll deposits, and withholding. Lane 3 is transactional reporting, things like 1099s, beneficial ownership issues where still applicable, and cross-border disclosures. If you mix those lanes together, you miss deadlines because you think one payment covers everything. It doesn't. Simply as it is, Delaware keeps the entity alive at the state level. The IRS cares about how the business is taxed and reported federally. And some forms are not about tax due at all. They are about disclosure. That distinction is where most penalty avoidance starts. This is the first misconception to kill. Delaware franchise tax is not a tax on profit. It is a state-level charge for the privilege of maintaining the entity under Delaware law. For domestic corporations, Delaware requires an annual report and franchise tax by March 1st, and failure triggers a $200 penalty plus 1.5% interest per month. For LLCs, LPs, and GPs, Delaware says there is no annual report, but the annual tax is due by June 1st, and the same penalty and interest structure applies if you miss it. Federal income tax is a completely different question. A corporation generally files Form 1120 and reports income, deductions, credits, and tax liability federally. That return is generally due by the 15th day of the fourth month after the end of the corporation's tax year. So when a founder says, "We already paid Delaware," that tells you almost nothing about whether the federal side was handled correctly. A limited liability and a corporation are not just different legal wrappers. They can produce different federal tax mechanics. The Internal Revenue Service says a single-member LLC is, by default, disregarded for federal income tax unless it elects corporate treatment on Form 8832. A multi-member LLC is by default treated as a partnership unless it elects otherwise. That means two founders can both say we have a Delaware limited company while having completely different filing obligations depending on ownership and elections. This matters because penalty exposure follows classification. A calendar year partnership files Form 1065, and the 2025 instructions state that the late filing penalty for returns required to be filed in 2026 is $255 per partner per month, up to 12 months. A C corporation filing late may face the standard failure to file penalty, generally 5% of tax due per month, up to 25%. This is where people get burned. In the US, some of the worst penalties are for missing information returns, not for underpaying tax. The cleanest example is the foreign-owned single-member LLC. The Revenue Service's instructions say a reporting corporation includes a 25% foreign-owned U.S. corporation, including a foreign-owned U.S. disregarded entity for Form 5472 purposes. That means a foreign-owned single-member limited can have that form filing obligation attached to a pro forma Form 1120, even if the founder assumes the LLC is pass-through and even if there was little activity. And the penalty is not symbolic. The instructions for Form 5472 say the penalty for failing to file when due and in the prescribed manner is $25,000. That is why "we didn't owe tax" is not a defense. The government separates tax due from reporting required, and founders who confuse those two categories donate money to the Treasury for no strategic reason at all. A lot of non-US founders hear tax treaty and assume that means they are basically out of the US tax system. That is not how it works. Revenue Publication 901 explains that tax treaties may provide reduced rates or even exemptions for certain residents of treaty countries. It also explains, in the business profits context, that such profits are generally exempt from US tax unless there is a permanent establishment in the United States. That can be powerful, but it does not mean you can ignore forms, documentation, or classification issues. Treaty relief also usually has to be documented properly. The Revenue Service says Form W8BEN-E is used by foreign entities to document status for withholding and other code purposes, and the form itself is given to the withholding agent or payer, not to the IRS directly. So treaties are not magic dust. They are legal positions that have to match your residence, entity type, income type, and paperwork trail. Because this area moved fast, a lot of founders are still operating on stale advice from 2024. FinCEN's March 2025 interim final rule exempted domestic entities and US persons from BOI reporting. FinCEN's current BOI guidance says all entities created in the United States, including those previously called domestic reporting companies, are now exempt from BOI reporting. Certain foreign companies registered to do business in the US may still have reporting obligations, but a standard Delaware entity created in the US is no longer in the old reporting bucket. People are still telling founders to file BOI because that used to be true for many domestic companies. Today, you need to check the current FinCEN position, not recycled content. For corporations, Form 1120 is generally due on the 15th day of the fourth month after year-end, and Form 7004 gives an automatic extension to file, not to pay. For partnerships, Form 1065 has its own deadline and late filing penalty structure. For corporations expecting estimated tax of $500 or more, the Revenue Service says installment payments are generally due on the 15th day of the 4th, 6th, 9th, and 12th months of the tax year. Then there is payroll. The IRS states that employers must deposit withheld federal income tax and both employer and employee Social Security and Medicare taxes, following either a monthly or semi-weekly deposit schedule. The failure to deposit penalty applies when employment taxes are not deposited on time, in the right amount, or in the right way. And if you pay contractors or furnish other information returns for forms like 1099 NEC and 1099 MISC, the due dates to recipients and to the IRS are not something you want to figure out later in January. The answer is less glamorous than founders hope. You avoid IRS penalties by making the structure and calendar boring. First, know how the entity is classified for federal tax purposes instead of assuming the legal form answers that by itself. Second, separate Delaware maintenance from federal filing. Third, identify whether you have information returns that apply even when tax due is zero, especially in foreign ownership situations. Fourth, use extensions correctly. They generally extend filing time, not payment time. Fifth, do not wait until a bank accountant or payment processor asks for old forms before discovering what should have been filed months earlier. What makes founders safe is not knowing tax in general. It is knowing which exact forms attach to their exact structure, which dates repeat every year, and which areas changed recently enough that old internet advice is dangerous.
So, here's the real founder takeaway. Delaware franchise tax is a state maintenance charge, not federal income tax. Federal income tax depends on classification, elections, income, and facts. Tax treaties can reduce US tax exposure in some cases, but they do not cancel the need for accurate reporting and documentation. BOI rules changed materially in 2025, so outdated advice can send founders in the wrong direction. And some of the nastiest penalties in the US are not about unpaid tax at all. They are about missing forms, late information returns, and ignored deposit schedules. If you want this handled properly, the winning move is not to memorize the whole Internal Revenue Code. It is to map your structure once, set the filing calendar correctly, and make sure every federal and Delaware obligation has an owner before the deadline arrives. And that is exactly the kind of thing Icon.Partners help founders coordinate in practice, not by promising loopholes, but by turning messy US compliance into a clean operating process.